do not use trading zones until you watch this video. This will make you a better trader and is a small 3-step method that you can use for your own trading. First of all, what a contraction phase is, if you don't know yet. If you make the chart small and you can see just the market wiggles around, those are called contraction phases. And the market is wiggling around and then shooting in a direction and just repeats that over again. There's also a very well explanation for that, but that's just too complicated. The simpler we keep it, the better. So you can see here the market is wiggling around, and what happens is the longer the contraction phase is, the higher the chance that if the market pushes away from it, that the market will come back to this contraction phase. Because trading the market is always about an auction process. That means the market wants to go to situations, to prices, what are attractive to trade more. Makes sense, right? And if there were a lot of participants trading here already, the market wants to go back just to figure out, like, is it a price that wants to be traded? So use drawing and contraction phases is something what is very important. And then that's step number 1. Step number 2 is, can you see that once the market goes away, that the market wants to go back to this contraction phase? If you have something to write, then write down a higher low means the market wants to go up. A lower high means that the market wants to go down. I don't watch too much on the other side. It can be a bit confusing because anxiety means actually that we tend to do something wrong in the future, and we have less anxiety by prioritizing high quality informations. So in this case, it will be a higher low. So red, green, as you can see here, and then you can see a red, green that goes higher. In reference here, he was also red, green that was going higher. But here you can see a lot of green candles, what the market does. And with experience, when you look at this over again, this makes more sense that the market goes back here into contraction phase than just trading here. What is absolutely cool using a 1-minute chart, if there's a red, green, and then another red, green, what I really love is, I love to use the square. Check this out. If I draw in this square here, this length, and I'm assuming the market will do the same retracement here, it will help me a bit not trading up here, just like within a green candle. It will help me to identify how big the retracement was here, to assume actually that the market will do the same retracement, or maybe like here, and then to use here the same rectangle to more take this kind of signal or even this signal. And the cool thing is, if this is out of a 1-minute chart, just a small candle, and I adjust here $100, my take profit will be $700 or even more. You can see here there's a risk reward ratio of 5. That means if I risk here around $100, maybe 75, I get $375 out in profit, trading back to the contraction phase. So again, step number 1, this is the contraction phase, letting the market push out. Understanding, is this a very long contraction phase? Because the longer the contraction phase is when making it small, the higher the chance for me, using experience with the market, that the market will go back there. Second step, can I see that the market does higher lows when it's under it or lower highs when it's above? And the third step is what I just showed you. Where is the best place to enter and how can I have the smallest risk? Because getting the $1,000 movement is not the biggest struggle. The biggest structural struggle is not losing more than $1,000 while being able to get a $1,000 movement. And the solution to that, what I really love, is to measure retracements, to get high quality informations, because the faster I can get these informations, the faster I can do also those high quality decisions. So a high quality information and decision for me is, for example, like this retracement that you see here, or for example, because the market did this kind of retracement, and then assume the market does the same retracement again, and then taking any green candle on the bottom side, such as here where my mouse is, or there. Or for example, even more better, if the market starts here in reference from red, green, to red, green, to here red, green, to make a higher low. And if the market starts here to make a higher low, stop placement just under the green candle, adjusting, I think just one position size is good, trading futures in the beginning, and making sure that there's a risk reward ratio of 5, aiming for the bottom, middle, or top of the contraction phase, always using a demo account first, please, and trading with one contract using the S&P 500 future.